Hi, I'm Marco Byrne, the Research Director of GoldCore.com, your precious metal storage specialist. And today, obviously, there's a lot of the risks are I suppose building up out there, and increasing indications that we're on the verge of a recession in terms of the yield curve inversion. And obviously, the Brexit saga continues, and I'm not going to get into the detail of it, but we want to get back to brass tacks about the case for gold and what is the case for gold in 2019, given the risks of Brexit and more importantly, the other risks that are out there. So we've put together a PowerPoint presentation, which we think is quite interesting, and hopefully you'll find it insightful. So without further ado, I'm going to just get straight into it. So I mean, these risks, people are just sick to death talking about Brexit, and there's been so many twists and turns, and there's going to be many more twists and turns. And the bottom line is we just don't know what the outcome of it will be, but we do know, by its very nature, the fact that we don't know, it's massive uncertainty, and that's beginning to impact the economies, particularly of the UK and indeed of Ireland. And data out today show that the mortgage market, mortgage approvals in the UK have fallen very sharply. The UK housing market is slowing down very significantly, and basically the economy, the real economy in the UK and indeed in Ireland, is beginning to be impacted by Brexit. And obviously, there's a bigger risk now of a no-deal Brexit. So, but that's just one risk that's out there. There's a lot of other very, very significant risks indeed, which I'm not going to go into right now. But we looked them. Obviously, we've looked them at our recent podcasts and our recent interview with Willie, and indeed our weekly podcasts. So, all the information is there about the risks. Let's look at how gold will protect people in these risks. And how gold will protect people is that because it is a hedge and a safe haven. So how is that, and why is that? And so let's look at some of the reasons, because there seems to be still a lot of doubt in the media when they cover gold. It's like gold is a perceived safe haven, or maybe gold isn't even a safe haven at all. Warren Buffett is quoted as saying that gold isn't a good investment at all. And so let's look at why is gold a safe haven. Basically, there's a huge amount of academic research, a huge amount of independent research from asset allocation experts showing that gold is a hedge and a safe haven asset. So we have quotations here from two fine professors of economics in Trinity College Dublin, and there's many academics throughout the world who have studied gold and basically said that it is a hedging instrument and a safe haven. There is a consensus in that regard. So, and that's from academia. There's also from independent asset allocation experts such as Ibbotson, Wainwright Economics, and indeed here one of the biggest accountancy firms in the world, PwC. So this is research from PwC. You can read for yourself. I'm not going to waste my time, your time reading to you. And that's what the biggest accountancy firm in the world is saying about gold. And then we have the man who manages a large part of the money supply on this planet of the euro, the not so single currency, and Mr. Mario Draghi. This man who is the ECB president talks about gold being a reserve of safety. So there you have it. Besides history, obviously, and thousands of years of history, and indeed more recent history in terms of financial crisis, history shows clearly that gold is a safe haven. But so does the research and the view of the people who manage our economies and manage our currencies today. So I think hopefully we've put that myth of gold being a volatile commodity and risky to bed right there with that slide. So why is gold a hedge and safe haven? Well, their research shows that gold either has a lack of correlation with risk assets, particularly stocks and to a degree bonds. It has a lack of correlation, or indeed it has an inverse correlation. So there are real risks out there. All the focus on Brexit right now in the short term, given the looming deadlines for Brexit. But there are bigger risks, and it looks like the Federal Reserve is going to go from quantitative tightening to quantitative easing. They're going to go ultra loose monetary policy again because of the vulnerable US economy. There's the trade wars, totally unresolved. The tensions with China are very real indeed, including military tensions in the South China Sea and the Straits of Taiwan. There's bank risk, Italian banks, Deutsche Bank and Commerzbank looks like there's going to be a forced marriage there. They're going to create a too big to bail bank in Germany and in the EU. There's Brexit. All these risks are very real, and at some stage we believe they potentially and most likely will lead to falling markets. So the gold price tends to increase in periods of systemic risk. What is the evidence for this? This is an excellent table here from our friends in the World Gold Council. They put out a wonderful research piece just recently talking about gold as a strategic asset in 2019. And I encourage you all to look and read and check out the tables and the graphs that the World Gold Council have in that research piece, because it's really excellent. This is just one of them. And it basically shows how stocks, particularly the S&P 500, which is the leading US benchmark and indeed one of the leading global benchmarks for the performance of stocks, how they have performed in periods of market risk and systemic risk. So if you look back, this chart is very interesting indeed. I'm not sure if you can see my mouse there. Sorry, I've gone ahead of myself. So you look in here, this is Black Monday. So this is 1987. Stock markets fell, our stock markets, the S&P 500 in purple fell over 30%. Meanwhile, gold here in the sort of dark gold, bronze color was up roughly nearly 10%. So that's 1987. If you go to the LTCM crisis in 1998, stock markets fell nearly 20%. Gold prices were up 2, 3, 4%. Dot-com bubble 1999, stock markets fell over 20%. Gold actually fell as well, but it didn't fall that much. It only fell 2 or 3%. September 11th, stock markets fell again, small enough amount, 3, 4%, and gold rose 3, 4% so after September 11th. And then we had the 2002 recession, which is partly related to September 11th and the uncertainty that created, and you can see stock markets fell, delayed reaction so much, which frequently happens. Stock markets down 30%, gold up 10%. The Great Recession, which is obviously subsequent to Lehman Brothers and 2008, and you can see stock markets fell nearly 45-50%, and gold was up 45-50%, nearly a perfect hedge during the greatest financial crisis the world has seen since the 1930s. And then we have the sovereign debt crisis, problems, concerns about the US debt, and then concerns about the European debt. Every single instance, all these major systemic risk, major market volatility, stock markets sell off, gold prices have gone up the majority of times. So I'm pretty confident if Brexit impacts the UK, Irish and European markets in the coming months and years, and we see sell-offs in stock markets due to that, or indeed the other risks, the trade wars, ultra-loose monetary policy, whatever it is, then you're going to see a similar trend happen in the gold market, and it will act again as a hedge and a safe haven. So it's just very, very important to realize that that is why gold is a hedge and a safe haven. And there's similar, if you look at property markets and how they performed in 2007, 2008 in many major economies, a lot of them came off quite significantly and gold prices went up. So it acted as a hedge, not just for stock markets, but for other assets as well. This is also in this report from the World Gold Council showing how gold outperforms stocks and bonds over the long term. And most people, there's a lot of nonsense spoken about gold. Warren Buffett came out recently again saying how gold has performed poorly over the long term, and if you'd bought gold 70 years ago or bought stocks, you would have done much better with stocks. Well, of course you would have, because gold was actually fixed from 1933 at $35 per ounce through to 1971 at $35 per ounce. So gold was constant, fixed. It was money, so it didn't go up or go down. It was a fixed price, where stocks went up and down and you had that risk. With gold you had no risk. It was just a fixed price. It was money. So you have to look at gold since 1971, when it became freely traded as a commodity or as a currency. And if you look at gold's performance over the long term since 1971, or indeed maybe that's too long a time frame for many people, 45 years is a very long time frame obviously, but look at over a 20-year time frame or 10-year time frame. So here we look at gold prices over the long term have done very well indeed, up nearly 10%. You can see here on the right here, the bronze. Sorry, I can't get my mouse over here so I can show that to you. So the bronze there, yeah, 10%. And then this here is commodities. This here is, this is European, Australasian, Far East. So it's sort of industrialized nations besides the American stock markets. This is the U.S. stocks, sort of light purple. This is U.S. bonds, yeah, so about 7.5%, and that's U.S. cash. So gold has performed nearly as well as any other asset over the very long term, 45 years. Over 20 years, gold has done very well as well. You know, it's outperformed the majority assets. It's outperformed U.S. stocks, as you can see. The only asset that hasn't outperformed is emerging market stocks. But so gold has delivered about 8% per annum over a 20-year period, which is an excellent return. And as I said, outperformed US stocks over that 20-year period because we've had lots of booms and busts and crashes, two crashes in the US stock market and the global stock market during that period. And this is 10 years. Over 10 years, gold hasn't done so well because we've seen a very significant recovery and rally in stock markets globally, particularly in US stocks. So you can see US stocks are very strongly 12.5% over the last 10-year period, and gold is only up 5%. But I think this chart here shows why now is a good time to actually allocate funds to gold, because gold has underperformed the short term. It's due to catch up with other assets, and I think it's going to revert to the mean, and you're going to see 10-15% returns in the coming years, whereas stocks look very overvalued. So I think, you know, if you're if you're talking to a financial advisor, you should be asking them about rebalancing your portfolio, because now is a very, very good time indeed to rebalance portfolios, and people should be doing that. That's not financial advice. We're not financial advisors. This is just what we believe you should do and what we would be doing and are doing. So very, very, again, yeah, very few people realize, including so-called financial experts and brokers and advisors, that gold has actually outperformed stocks, but this is what the latest data shows. So I want to get into just the context here of gold and why is gold a safe haven? Why does it have value in the world of today? And why will it have value in the world today? And the reason is, it's not biblical. I'm not going to get biblical on you. I'm not going to start preaching from the pulpit here, the gospel of gold. But I think this is fascinating, the story of putting in context, I suppose, the size of what a trillion is. So what is a trillion? Because I think people are completely bamboozled by figures today, and they've no concept of the scale of the amount of debt in the world, the amount of liabilities in the world, the amount of quantitative easing that central banks have engaged in, and the massive expansion in the money supply in the world. So people need to understand that vis-a-vis the very small supply of gold in the world. So a trillion, you know, we used to talk about millions, we used to talk about billions, now we're talking about trillions, and we're actually beginning to talk about quadrillions. So you'll be hearing that word in the coming months and years, and that's the amount of derivatives in the world are actually 1 quadrillion. But on a trillion, I didn't realize, but the American trillion is 1 to the power of 12. So it's a million billion, and 1 with 12 zeros. So it's a very, very, very big number. And I think even people in financial services lose sight of the scale of these numbers, what a trillion is, you know. I didn't realize the British trillion is actually 1 to the power, or 10 to the power of 18. So, you know, massive numbers. As Google Dictionary says, it's a very large number. Well, that's putting it mildly. It's a huge number, and it's important to be mindful of that when someone tries to tell you that gold doesn't have a value or is a barbaric relic from the past. So for people to try and understand, so Jesus Christ was born in 00 AD. If he was alive today, and he lived 2019 years, and he was spending $1 million every single day of his life, since he was born in 0 AD, he would not have spent $1 trillion. He would only have spent 750 million. And knowing Jesus Christ and what they say about him, I'm sure he would have been spending that on he would have been a great philanthropist. He would have been spending it on charities. And with the money he had spent over the years, we probably would have eradicated poverty at this stage. So, but it's huge. That's like 2019 years by 365 days. You're still well below what 1 trillion is. Meanwhile, if you took all the gold in the world that's been mined since the dawn of time, since we came out of caves, and you refine that into one giant gold cube, so 20 meters cubed. A giant cube. It's basically it's 22 meters cubed. So this is a video that we did in 2009 called Goldnomics that has sort of a mini viral effect back then, and we thought it was very important for people to understand the size of the gold market in terms of supply and demand. Gold is very, very rare, as we said in that video, and that's how rare gold is, you know. And the gold supply only increases about 1.5% per annum. So there's about, today, that number is a bit dated. I think that the supply is about 190,000 metric tons, and it's increasing about 3,500 tons per annum. And a ton sounds like a lot of gold. It's actually not. Gold is a very heavy metal, so 1 ton of gold is probably, you know, you'd fit it on my desk here. It would collapse the desk because it'd be very heavy indeed. And I don't know how we get it in here, but it would fit it in terms of the diameters. It would fit in this. So gold is a very, very heavy metal, and that's why when it's condensed into one giant gold bar, it's 22 meters cubed, and this is accepted by Mario Draghi, by Jerome Powell, by the central bankers of the world, by the Goldman Sachs, the big banks of the world, the bullion banks such as JP Morgan and HSBC and all the rest of them, and indeed by USGS, the US Geological Survey. So geologists around the world, the mining companies, anybody involved in the gold industry accepts this fact, you know. And who knows, maybe there's a little bit more gold now, even if there's double the amount of gold that they say, which is highly unlikely, but even if there was, it's still very, very rare, you know, and we're having to go deeper and deeper and deeper into the gold to get the gold out. And there haven't been any major gold mining finds for many, many years now. And gold mining supply is actually beginning to peak, or at least plateau. So, and that's something we've written about and spoken about for a long period of time. Gold mining supply is plateauing, and that means if you get a spike in demand, the supply is not going to increase anytime soon. And there's a lot of nonsense talk from Elon Musk and people talking about going to asteroids and Mars and all sorts of places to mine gold. We can barely get gold out of the ground here on this planet, let alone getting people onto other planets, whether it be Moon or anywhere else, and getting the gold off those planets, mining it, extracting it, and then getting it down to Earth. Can you imagine how costly that would be? Maybe they can do it in time. In 50 or 100 years, possibly they can do that. But the cost of getting that gold back to this little planet would be in the hundreds of thousands, if not millions per ounce. So that's potentially where the gold price will go if they go down that road. And one of the things, there's nonsense talk about going mining gold under the sea. Again, it's so costly to mine gold on Earth because it's very energy intensive. And if you try to do it underwater, it's going to be 5, 10, 20, 30 times more expensive to mine it, you know. So it's not really feasible, and that's why the supply demand equation for gold is very, very good indeed. And that's why man has valued gold throughout history. Instinctually we know it's rare, and that's why we value it, and that's why it will almost certainly always have a value. And in today's uncertain times, I think it's certain to continue to have value for the very foreseeable future. I think for at least for my lifetime, you know, unless humanity evolves and our consciousness evolves quite dramatically, which unfortunately in the short term is looking a little bit unlikely. There are some positive developments in that regard. But anyway, I digress. So we talked about Mario Draghi. So who are the biggest buyers of gold in the world today? Well, the people who manage your money, the people who manage your currency, you know, the people who manage our financial systems and our economic systems, they are the biggest buyers of gold in the world today. They're the biggest buyers of gold in 2018. They bought more gold in 2018 than any time since World War II. So, and the biggest creditor nation central banks, the People's Bank of China and the Russian Central Bank, are leading the way in terms of their gold accumulation. And the Chinese actually have 2 sovereign wealth funds where they're potentially buying a lot of gold and not actually declaring it. The stories of the People's Liberation Army, the Chinese, the Army of China, actually scouring Africa and actually extracting a lot of gold out of Africa and bring it into China, you know. So and from credible sources as well. So the big creditor nations are buying gold, and gold still remains a tiny amount of their overall foreign exchange reserve. So you can see Russia, only last week came out data, Russia bought another 1 million ounces in February alone, 31.1 metric tons from Russia. Russia are moving up, and they're now the 5th biggest owner of gold in the world, as you can see here. And what's even more interesting is, besides them buying gold, but the biggest central banks in the world, the United States, Germany, International Monetary Fund, interesting, the IMF actually owns a lot of gold. Oh, I wonder why. Italy, France, Switzerland, Japan, Netherlands, India, and the European Central Bank, the ECB, owns 504 metric tons of gold. Again, I wonder why. The reason why they own it and they haven't sold it is they know it's, as Mario Draghi said, a reserve of safety that will protect them, their currencies, from worst case scenarios. So it's a hedge, it's a safe haven monetary instrument, a safe haven form of money. So Ray Dalio, very interesting man, one of the most respected investment managers in the world today. Bridgewater, biggest hedge fund, investment fund in the world today. And he's very interesting videos on YouTube, well worth reading his books and listening to his interviews. And he knows his financial history, unlike a lot of people today who seem to think that they can ignore financial history, and that we're in some new paradigm. Well, we're not. There's no new paradigm. We're in the same paradigm, and we're soon. People will realize that very soon again. So that's his quotation, and it's so very, very true. So besides central banks, also some of the most respected investors in the world, besides Ray Dalio, are also buying gold and investing in gold, including the Rothschilds and Lord Jacob Rothschild, who was warned of this being one of the greatest monetary experiments that the world has ever seen. And then we have two of the most respected bond managers in the world. So the bond kings, the first bond king and his successor, the pretender to the crown, Mr. Bill Gross and Mr. Jeffrey Gundlach, and here you have the positive things they have to say about gold. So it just again, something big is happening. It's getting exciting. That was Gundlach on CNBC very recently indeed. And he is just, the yield curve is inverted just in recent days, and he's come out and said, yeah, we're on the verge of recession. It's 2007, 2008, So coming full circle in terms of the big 1 trillion number, and what a huge number that is, one with 12 zeros, a million billion. Sorry, no, it's 1,000, which is 1,000 billion. Yeah, exactly. So it's they're huge. They're monumental, humongous numbers. We had an event for GPs last week who were concerned about their pensions and pension liabilities and the outlook for pensions. And we had a look at this, and the pensions time bomb is just, we've all talked about for years. They've kicked the can down the road, but we're coming to the end of that road. And soon there's going to be very severe ramifications indeed in terms of our pensions and potential pension levies and pension confiscations and huge risks. So the pensions time bomb today is 70 trillion, but the projections are it'll be 400 trillion by 2050. So, it's just completely unsustainable. And another reason to own gold. And you can own it in your pension, including with ourselves, a self-administered pension. So the global debt bubble is just, again, you're talking about, trillions and trillions. So, we're now touching on 250 trillion. These tables are just a tiny bit out of date, not huge out of date, but look at that. Global debt is up almost 150 trillion in 15 years. So that's 10 trillion a year in 15 years, and that's in a so-called recovery. Can you imagine when we go into this next recession? The bottom right-hand chart there is the most importantly, debt by itself is not a bad thing per se. Debt by itself is not a negative per se, and the increase in debt is not necessarily negative, providing the GDP growth is actually as big, if not bigger, than the increase in debt, and that's not the case. So you have to look at the global debt to GDP ratio, as we've long said, and that is actually increasing very significantly as well. And there's different projections and different estimates from different organizations, but some people are saying it's over 300%. 250 trillion debt versus global GDP of around just under 90 trillion. So, and global, just so you understand, global GDP is basically the value of every single good and service that's traded by every single person on this planet, all 7 billion of us, and every single company and government, every single good and service traded in the 1 year. And the debt is 3 times bigger than that. So, I mean, that's just completely unsustainable. As we know, it's sustainable now while interest rates have been pushed near zero, but that cannot last forever. And the debt actually makes the likelihood of interest rates going much higher in the medium and long term. So, so it's a classic vicious circle there. The bottom right hand there, evolution of global debt to GDP, no post-crisis deleveraging. So it's basically making a point, you know, after the crisis, you would expect the debt to have come down and the debt to GDP ratio to come down as the GDP increased and debt went down. That hasn't happened. The debt has increased exponentially compared to the GDP. So that chart is actually out of date because it's 2014. Apologies, but I still think it's quite a powerful chart. So that chart that's actually gone headed up in this direction, up here, up to 300%. So it's not sustainable, and that's why it's important to start diversifying, reducing allocations to risk assets, and having that allocation to safe haven gold. So outlook for gold in 2019, the coming years, I always really like this table because it shows how gold has done very, very well over the last 15 years. Tough time, 2013, when the rest of the stock markets and the wider economy started to recover. A very sharp fall in the gold price, partly, large part, I think, manipulated lower actually, but it had got overvalued in the short term. It was due a correction, but I think the scale of correction was due to manipulation, and the scale of the length of the duration of how gold has remained depressed in recent years, I think is also in large part due to manipulation, but that's a separate matter for a different day, shall we say. But the bottom line here is you can see gold in US dollars up 9.3% per annum over 15 years. In euros, 8.8%, and in sterling, 11.2%, because obviously gold has done quite well and recovered quite well in sterling, particularly in recent years, given the Brexit uncertainty and the massive debt levels that the UK itself has. So as we say, history does not repeat, but frequently rhymes, and we think we'll see a similar pattern to this period here in the coming months and years. So where are we in the cycle? I think we're actually around hope. We've moved from depression in recent months and years into just the early stages of hope. I think, you know, some of our clients and people who are more aware investors, more risk-averse investors, are beginning to diversify into gold again, and indeed we're getting a lot of business from people who bought gold ETFs or from digital gold providers, XYZ.com gold provider, and they're concerned about the risks from that provider, and they're beginning to diversify and move their assets over to us because we do gold, as I'll talk about in a second, in a very secure way indeed. So before I get into just a little bit of information about us, actually, well, yeah, no, I'll put it up so you can be digesting it. I don't want to be reading through things and doing a death by PowerPoint where I'm repetitively reading what you can see on the screen. So that's the information about GoldCore. But I just want to talk about the special offer that we have, exclusive offer that we have only for people who have accounts open with us or who are clients for the next 3 weeks up until April 18th. We have an exclusive offer which is very attractive indeed. So for the first time ever, we're actually allowing people who trade with us and buy 10,000 euros, dollars or pounds worth of gold stored in our allocated, segregated, secure vaults in Zurich, Switzerland. They will get 6 months free storage. Which is very attractive indeed for allocated and segregated storage. They will also get a copy of this wonderful book, which is The Case for Gold by Mr. James G. Rickards. It's an excellent book, and it sort of gives the case for gold in terms of the digital risks and the cyber risks we have today in terms of cyber terrorism, cyber war, and the digital bank deposits that we have, and the very significant risk and underappreciated risk that there is in that regard. So you get a free copy of this book here. And finally, we'll also have this is a tube of silver eagles from the United States Mint. So these are legal tender 1 ounce silver bullion coins. And that is basically, it's a legal tender US dollar. It's a $1 legal tender coin from the US Mint. So you'll also get one of these coins when you free insured delivery, when you trade, as I said, 10,000 euros or 10,000 pounds or dollars up until April 18th. So that's real money there. That's a tube of silver eagles, and you can hear that's real money and real wealth. So we just think with these risks, we want to encourage people to diversify, own gold in more than one location, take delivery of some if you feel secure in your own home, and then own gold. We believe Zurich continues to be one of the safest, if not the safest jurisdiction in the world, and we believe the Loomis Zurich vaults, where we store gold on behalf of our clients, is probably the safest vaults and safest location in the world. So that's a little bit about us. If you're not familiar with GoldCore, that's essentially who we are. And I'm not going to go on about it. We are trusted. We're in business since 2003. We've 16,000 account holders, 6,000 clients have actually transacted with us. And everything from taking delivery of crew grants, kilobars, everything to permit certificates, and now allocating segregated storage in some of the safest vaults in the world. So the permit we continue to have an excellent relationship with, and this is a quotation from the manager of the permit depository, John Durham, and lovely man that he is. And I didn't have to buy him lunch or dinner or pints of beer in order for him to give us this quotation. So just a little bit about the how-to. I think we've shown clearly how gold is a safe haven. It's so clear if you know your financial and monetary history, but the data's there, the research is there. If you're in any way open-minded, you'll realize that. And so it is a safe haven, but it's only a safe haven if you own it in the safest way possible. And that's what we specialize in, because we've long said, let's allow people to own gold in the safest ways possible. So how might you work together with GoldCore? So this is the client solution. We only buy from the biggest gold and silver refineries in the world, and the leading government mints. So we're buying gold within the chain of integrity from these partners. It goes into the vaults, which are also in the chain of integrity, and we work with Loomis and GSLS and Brinks. And it's fully insured, so it's very, 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 very secure. And then what we do, which distinguishes us from both the ETFs, in which case you're an unsecured creditor of a trust, and you own shares in a trust, and you have a huge amount of risk to all the counterparties, the custodians, the sub-custodians, the promoters, all the rest of it. With us, you have outright legal title and ownership of your individually allocated and segregated coins and bars in your name, so you're eliminating your counterparty risk to GoldCore. And you can see there's no commingling whatsoever for both coins, small bars and large bars. And you can actually, I think it comes into that in the next slide. This is an important point, that liquidity and competitive pricing. You don't ever have to sell your gold back to us. So you can call us up, and if we say to you, actually, we're going to buy your gold at 5% or 10% or 20% below the market price, and you're horrified, well, you can quickly say, listen, that's not competitive. I'm going to sell someplace else. give me my gold, take delivery of your gold, and or move your gold from within the vault or to another vault or to another provider within the vault, and then you can sell your gold. So you have that liquidity. If for whatever reason you couldn't contact GoldCore on the phone or by email, or our websites are down for a period of time, in terms of these global risks of cyber terrorism and electromagnetic pulse attacks on the electrical grid, if for whatever reason you couldn't contact us for a period of time, you can go directly to the vault provider and you can instruct them to move your gold or ship your gold, and then you can sell your gold to a third-party provider, and that ensures you both have liquidity, but you also have competitive pricing. Because with an ETF, they can change the pricing. They just, in the terms and conditions, they can just change the pricing. Similarly with, XYZ, moneygold.com website, you're totally dependent on their website and their portal and their technology and their management. And if some bank or some other hedge fund buys out this company, they could quickly blow out the spreads in terms of the price that you get, and they could say, right, we're going to buy that gold off you at 7% below spot rather than at 1% below spot, and you are a price taker and you have no option but to sell your gold back to them through their platform. Yeah, you're never an unsecured creditor of GoldCore. Yeah, I lose that as well. So this keeps us honest. We'll give you your trade confirmations, your asset statements. You can log on to our website. You can see exactly what you own in terms of the coins and the amount and the exact nature of the coins. And then on the bars, you can see exactly which refiner it is and the serial number for each bar. But also then you can actually go directly onto Loomis in Zurich, in Hong Kong, in Dublin, and you can go on to Brinks in Singapore, and you can actually log on to their websites with your login information, and then you can independently corroborate and verify what we are telling you in terms of what your holdings are, which is very important from a transparency point of view. So, and that's obviously important as well in terms of auditing. So after trade data, confirmations, asset statements, P&L reports. Yeah, this is all available, through the customer service and through our portal, and it's quite sophisticated compared to most of our competitors in this regard, and that's why we can work with brokers and financial advisors and institutions. So next steps. So you have to decide what type of client account you want. This is important. Your motivation for buying. Are you an investor taking a 5-year, 10-year time frame? Is this a permanent holding? Which we suggest there should always be a component which is a permanent holding. It's financial insurance to hedge against these worst case scenarios. Somebody you're potentially going to get the children, grandchildren, whatever it is. But sometimes there's people who have no children, no dependents whatsoever, and they simply just want protection for a shorter time period, and they'll gradually sell some of their gold over a period of time, and that makes sense. So it's very much about, I suppose, your motivations and your circumstances, and we're very good at actually having conversations with people in here, with the team in here, and trying to help people own gold in the way that is most optimal and most beneficial for them. So yeah, fund account, we take payments in all major currencies, wire transfers, credit cards up to 50,000 euros, pounds, and dollars. Place trade, you can do that online or on the phone. You're not dependent solely on the website. We do have phone coverage as well, and a team of people in here that will help people in terms of trading, both buying and selling. And then the important thing is the exit and how to sell, because oftentimes people don't think about that. They're trying to get up to speed and understand the buying and the pricing and all that, but they don't actually think about the selling. And I alluded to this before in the last slide in terms of the liquidity is very important, and the pricing, and ensuring you get a competitive price when you go to sell. So you have to consider how to sell and when you're going to sell. Is it a permanent holding? Will you be taking profits on some of it? I mean, some of our clients, and I think it makes sense, if gold does go parabolic and becomes very overvalued in short term, there may be a place for, if you've got 20% of your portfolio in gold, potentially you sell 10% of that and you take profits from that, and then you hold the other 10% as your financial insurance, So, and just on that is, the allocation is a fundamental thing that we help people as well. And we've long said that people should have the 5-10% allocation to gold. The old Wall Street adage is you have 10% of your wealth in gold and you hope to God it doesn't work, because if it does work, it generally means the rest rest of your wealth, the rest of your portfolio is not doing well. So, given the risks of today and the risks posed to the euro, the dollar, the pound, the banking system, the financial system, the monetary system, we do think there is a case for higher allocations to gold, and indeed we believe people should own some silver as well. So you could have, 25, 30, 40% of a portfolio in gold given the risks of today. So that's the how to sell. If it's stored with us, in vaults with us, then it's in what's called the chain of integrity, which ensures its authenticity. And that means that it's much easier, obviously, in terms of selling it. In terms of liquidity, it's as simple as simply calling us up or placing the trade online. You log into your portal and you can place the trade online. You do the sell order, you receive the funds within a matter of days. I think it's 3 or 4 working days. When you've taken delivery and taken the gold and silver coins and bars outside of chain of integrity, it becomes a little bit more cumbersome, a little bit more time consuming. So basically you need to package up the coins and bars, put them into a sealed box. You need to get the box to our vaults in Dublin, London, Zurich, Hong Kong, Singapore, and that can be done with UPS, Royal Mail, the usual providers. And then once it comes in, then we'll get a verification from the specialist gold vault providers that we work with, such as Loomis and Brinks, and they'll confirm that it is authentic gold coins, gold bars, and then we confirm the pricing, and then you decide, okay, I want to lock in prices on some or all of that, and then we wire the funds to you, back to either a bank account that you wired funds to us or another bank account in your name. So it's all fairly straightforward, but it is important to consider that the exit side of things in terms of buying and selling. And one other thing I should say is that for investors, I mean, we deal with retail investors, with pension investors, self-administered pensions, including some interesting IRA, individual retirement account business recently, and we deal with high net worth clients, family offices. We also deal with, the small retail investor who doesn't have the large lump sum, and we have Gold Saver, which is a gold accumulation program where you can set it up as a direct debit, and you can do $100, €100, £100 per month. And it's beautiful because once you set it up, it takes 3, 4, 5 minutes, and then it's set up, and every single month, I think it's on the 4th or 5th day of every single month, you are accumulating that $100, euros, pounds worth of gold, and then after 12 months you can actually redeem that for physical gold, or you can choose to roll it over and to save for another 12 months. So it's a very interesting and very I suppose easy and beneficial gold product that is very popular with smaller investors and smaller savers. So I think, the risk of repeating myself, I think we've covered all the bases. So I think the risks are real. The Brexit, again, we don't know how it's going to play out, but I think it's beginning to impact. It's just one of many factors. I mean, the London property market was overvalued in and of itself, but I think the uncertainty from Brexit and these other global risks is beginning to impact particularly the UK and Irish property markets and economies. But I think it will also in time impact the European Union and the EU economy, which is one of the largest economies in the world. And then obviously there are these other significant macroeconomic, systemic, geopolitical and monetary risks in the world. Is the four lenses that we look at, and these are real risks, and hence the importance of owning the safe haven gold in the coming months and years. So thanks again for your time. I hope you enjoyed the presentation. Hope you got some value from it, and feel free to reach out to us if you have any questions at all. The contact details are there. And there will be a link to the exclusive offer somewhere on the side of this video, and at the end of the at the top right of the video, I think it's in the I button, and also at the end of the video you'll have a link to the exclusive offer if that is of interest to you. So thanks again, take care, bye bye.